Investing in China is very risky, or is it one of those opportunities that come around once in a lifetime where you can turn around your portfolio? On one hand, we have Jim Cramer, who says that it is impossible to recommend Chinese stocks due to the communist regime. However, on the other hand, we have Charlie Munger, who has doubled down on buying more of Alibaba stocks. So which side is correct? In today's video, we will take an objective look on both these points of view and also see some of these prominent Chinese stocks that have been trading on the US stock market, as well as my personal take on the Chinese stock and some of my investments in Chinese stocks as well. And lastly, we'll try to answer the question if buying the Chinese stock is risky or not. So if that is something you're interested in, keep watching and let's get this rolling. There is always two sides of a coin. So let's start off with the folks who are supporting investing in China, and they have some very valid arguments on why you should be investing in Chinese stocks.
Yeah, good morning, Seema. It has been challenging, but you think about 2022 globally, and really our theme is normalization, especially for the developed world. And so you think about China and how it needs to catch up in terms of both performance, but also economic growth. And we think there's quite a lot of attractiveness there. You know, in some respects, at the index level, you're looking at the best entry point into Chinese equities in at least 4 years. And so, you know, what's happening is that the index itself is cheap, but also the underlying stocks within China are cheap as well. And I understand that there are a lot of concerns out there around regulatory antitrust, which has been the theme of the last 2 years. There's also the question that's been plaguing investing in China over the last decade, which is whether China will have a hard landing. You know, we had issues with Evergrande and the debt market this past year as well. We think that those are just long-term issues that'll simmer down and basically be in the background throughout next year. But for most investors who are underweight China, especially when you're looking at the onshore A-share market, we think this is a great time to slowly get in. We wouldn't get in 100% right away, but to start getting in at these really low valuations, we think that's probably a good thing to add to most portfolios.
Well, it's been a variety of different things, but the big drag on EM this year has been China. What we've seen is investors running away from Chinese equities on the view that China has become uninvestable, which I would argue is a big mistake. And Chinese equities have really been, I think, very oversold in the past year on concerns about increasing regulations as well as slowing growth.
Is this a sign of a turning point? Why are you bullish?
Well, it could be because what we've seen is a situation in which this is a buying opportunity. Valuations are quite attractive, and we think we're getting closer to the end of regulations as opposed to the beginning of more regulations. In fact, if we were to chart the regs over the past year, they peaked this summer and have come down since then. So this could be an environment, especially given that China is enacting fiscal and monetary support that should propel Chinese economic growth higher in 2022, carrying along equities with it.
The next side of the coin on why you should not be investing in China, let's hear their take as well.
Bond King Jeffrey Gundlach, who just had a comment that China is uninvestable, that you agree with him. And I wanted to ask you about that because this morning we learned that Charlie Munger has invested in Alibaba. Obviously, Alibaba's come down in price, but he is making a bet on China. What do you think?
Well, look, there is a sense that the middle class is going to do better in China, so therefore they'll buy more on Alibaba. My problem is that President Xi, there's a really good article, by the way. We've been reading a couple good articles, but just don't. We get the feeling, frankly, that he's a communist, that he's more Maoist than we thought. That he may be the first real totalitarian dictator in a long time, and he's going to be someone who doesn't really care about capitalism. And in that backdrop, I mean, can you imagine a president that feels like that here and then trying to buy stocks? I mean, I just think it's impossible.
Over about a third of China's economy is driven by the real estate markets. And what she figured out is with their money printing about on the same scale ours is as a percentage of the economy, and the rampant speculation in real estate in China prices got so high that you saw the average birth rate of the Chinese woman went down to 1.2. You need a birth rate of 2.1 just to sustain the population. So you have an aggressive population decline because the Chinese families, the men can't afford to buy the homes because they're 20 and 30 times their average annual income. And so they're living in their parents' basements and not having kids. And they finally realized that this crackdown isn't about a market crackdown necessarily. It might be a little about a billionaire crackdown and the corruption crackdown in China, which will happen ad infinitum. But I think it's really important to note that Xi needs real estate prices down, and he needs them to stay down. People that are kind of betting on a bounce, I think that's kind of a fool's game.
On the bullish side, these are the three reasons that have been talked about. Number one, they're talking about that because of the extensive sell-off in the Chinese stocks, the Chinese equities are at a very fair value and at a very attractive evaluation. The second point they talk about is the rising middle class in China that is boosting and bolstering the growth of these companies. And lastly, they're talking about the increase in the capital market and how all these different sectors of the economy are growing at a massive pace. On the bearish side, these are the two main reasons that are being talked about. Number one is Xi Jinping, who we heard about from Jim Cramer and Kyle Bass. Number two, keeping the real estate market as low as possible so that Chinese government can encourage the citizens to buy more houses, which currently they are unable to afford. So let's take a step back and look at these major Chinese stocks that are the go-to names when it comes to investing. So our first stock will be Alibaba. In the 1 year time frame, Alibaba has gone down about 45.85%. Year to date, they are up 10%. And in the 5 year time period, Alibaba has returned you about 36.67%. The 52-week price range has been between $108 and $274. Moving on to JD.com. JD.com has been down about 18% more or less in 1 year time frame. Year to date, so far they're up 5%, and in the 5 year time frame they're up 174%. After looking at the prices of these companies, you can understand why the bulls are looking at this as an attractive valuation for these companies, because the companies were trading at high multiples and high premiums. However, you also have to consider all the risks that come along with it. Number one risk is how Didi got delisted from the New York Stock Exchange. The second risk that we see is with the Evergrande crisis, and Evergrande still hasn't paid its debt to the foreign investors. Risk number three is, of course, the Chinese government, which can change the regulations at any point in time to suit their country's economic policies. So as an investor, what should we do? Well, there are two scenarios that could play very well here. Number one, that you are a risk-averse investor. In that case, you avoid the Chinese stock exposures altogether and you stick with the US markets. Now, if second scenario is if you are a more bolder investor and you have a lot more time, you may want to look into options of investing in Chinese stocks. In either case scenarios, regardless of whether you invest in Chinese stocks or American stocks, you always have to assess the risk to reward in your portfolio. I made this video just to bring these two bulls and bear scenarios in front of you to see and assess for yourself, and even do your own due diligence and research to see whether you are an investor who is willing to take that leap of faith and be more risky if you want to invest in Chinese stocks. There is no doubt that these are quality companies and they will continue to grow in leaps and bounds in the coming years. With that said, I personally have some leap options on companies like Baba, EDU, Baidu, etc. However, they only account for about 1% of my portfolio. If you found any value out of today's content, don't forget to hit the like, click on subscribe, and ring the bell notification. I will see you next time, Investor Family, but don't forget to invest for tomorrow.